And now for more discussions on the U.S. debt ceiling issue and the potential downgrade of the country's sovereign ratings, we're joined by Daryl Guppy, CEO of GuppyTraders.com. Thank you for joining us, Mr. Guppy. So could you explain what an active watch could mean for the sovereign ratings of the United States and how it would affect borrowing costs for trillions of dollars?
This is really a shot across the bows. It's a warning to legislators that they need to reach an agreement. But it's not the first time. In 2011, S&P downgraded the United States to AA+, and that set off a cascade of other downgrades as well as a stock market sell-off. And that's the danger we're looking at, because it increases borrowing costs for national debt, it cascades into private debt. And in this current situation, a sell-off in the market comes on top of the current bank uncertainty, which means it could be more severe.
And it is very high-stake talks. In what ways has the debt ceiling influenced the creditworthiness of the United States and the status of the U.S. dollar as a global reserve currency?
Doubts about its creditworthiness could spook foreign investors and governments, which of course are major holders of US debt, and that threatens the nation's ability to finance itself on terms that are as favourable as they had been in the past. They carry a higher interest rate risk premium, and that upsets its international standing. Now, it's more serious this time because the respect for the dollar globally is falling as the dollar's been weaponised by Trump and Biden and by increased use of sanctions. It's not the first time the US has defaulted. There have been 4 previous default situations. The most recent was in 1971, where they broke the government's commitment to redeem dollars held by foreign governments for gold. And that was the breaking of the Bretton Woods Agreement. Nixon said it was temporary. The Treasury Secretary told his counterparts, the dollar is our currency, but it's your problem. Now, we have the same response happening today, but now that response is less acceptable because there are now alternatives to this abuse of the exorbitant privilege of a global reserve currency.
The decision by the Fitch rating has sent jitters to global markets. How probable do you believe that it is that the debt ceiling issue will be resolved before a specific date? Should we get prepared for this despite the very low possibility?
I think the possibility is relatively low. Now, just think of it. X day means that government wages is not paid. That's happened before under Obama and Clinton. So it's not the end of the world for financial or debt markets. It's terrible for workers and business cash flow. What's more important is that what we might call the double X day, which is June 15. And that's when interest payments are due on market debt. That hasn't been missed before. The disintegration of functional government after the attempted coup d'etat last year means that these limits are more likely to be tested and may even be broken. So it's a far more serious situation than we've had in the past. The double X day is the one we're looking for.
So how might the increasing partisanship in the United States have a long-term impact on its economy beyond this debt ceiling crisis?
Well, you could say that in a country with a high firearms ownership, it's not surprising when the country shoots itself in the foot. The increased disruption to the normal process of government and an increase in its inability to deliver economic security to its citizens, this hastens the loss of the exorbitant privilege enjoyed by the US dollar as a global reserve currency. Investors will reduce their financing of its debt and seek alternatives, and some of those alternatives are emerging. We will see higher interest rates, both in the commercial market, which kills economic growth. They are the most significant impacts of this current crisis.
Well, thank you so much for your analysis. It was a pleasure talking to you. There was Daryl Guppy, CEO of GuppyTraders.com for us.